The most important factor you need to know as a borrower is whether your construction loan is Dutch or non-Dutch. In this video, I'm going to explain why hard money might be the perfect financing solution for your next modular or manufactured housing project. So the real problem for most builders, if they go off to a bank, is that first off, they hate the bank process to begin with. They want to scale, and that's the purpose of going and building modular or manufacturers. You know, they're going to do volume, and they can't wrap their head around taking more than one property or build to a bank to finance it. Not to mention the bank will end up looking at debt to income ratios and what have you, and ultimately limit the amount of builds you can do. And then they'll take their time funding draws and what have you. And that just doesn't work for builders in this day and age. You need to move quickly, and you need to take advantage of what these properties have, which is hopefully a defined timeline. You know that the manufacturer is going to have the house delivered and assembled on site on a foundation within a particular time frame. You know that that's going to happen, at least per the contract. So the idea is, let's get financing aligned with your strategy and ultimately where you're going. And in this video, we're going to talk a little bit about how, pro builders who do these manufactured housing projects use my money for speed and why it works so well in these situations. Before we go any further with the video, the most important factor you need to know as a borrower is whether your construction loan is Dutch or non-Dutch. And I've done a video on this particular topic, but the difference is simple. It's paying interest day one on the full loan amount versus paying interest only on the outstanding balance. And the amount sitting in escrow for construction doesn't get charged interest on until it's funded in draws, as you would expect. And I've discussed that topic as well in other videos. So it's important to know whether your loan is Dutch or non-Dutch, because that dramatically changes the calculation in terms of your cost of borrowing, and it flips the economics of doing a loan like this upside down. So first off, Dutch, non-Dutch, make sure your loan is non-Dutch. All my loans are non-Dutch. So let's talk about the timeline of a manufactured build and how they get funded. As a lender, we're gonna fund up to 70% on the land plus 100% of your construction plus interest carry, right? And we're gonna fund it in draws, reimbursing you for work complete. So the first funding will be up to 70% of the land. The next funding by us is typically when the borrower completes the site work and puts the foundation in. So the first construction draw, site work, foundation, second construction draw. The house gets delivered on the foundation. It becomes part of our collateral. We then fund 100% of what it costs for that house to be designed, built, and delivered to the foundation. So that's draw number two. Draw number three, and the final draw typically is just buttoning it up, connecting it to utilities, doing some cosmetic updates and finishes, whatever it is that the buyer wants, and then you're finally fully funded on the loan. So once the loan is fully funded, obviously you're on the market to be sold and you're trying to sell it as quickly as possible. So you can see in that timeline how most of your interest is going to be paid upon delivery of the house through the sale of the house. And so the timeline that you'd be paying interest on is very condensed, which is why, again, it lends itself perfectly for hard money. There's your timeline. So when you look at that, you say to yourself, okay, I'm not paying really much, if any, interest until the house is delivered. And then it's a race to get it completed and sold. It really acts like a fix and flip, because the bulk of your interest carry is going to be in the time it takes from the house being delivered by the manufacturer to the time it takes to sell, effectively leaving you with buttoning it up and positioning it for sale, much like a fix and flip would. And so the amount of time you're paying interest is only during that period, other than the minimal interest you're paying on the land and the site work and the foundation. So it's like, at the end of the day, you may have been out 6-9 months just to get to the point where the house is ready to go on market. You're ready and on the market. Again, I can't stress it enough. The time that you're paying interest is so shortened in this case. It's just really why it works so well for hard money, because you don't want hard money loans out very long. And under a normal build, you might, in this case, be paying more and more interest because you're funding at each point of the construction. So you might get through half of framing and call for a draw. Your loan balance goes up, your interest carry goes up. You might then go through and finish the rest of the framing and the siding, and now all of a sudden you pull another $100,000 and your interest is now going up by another, $1,000 a month. It's important for borrowers or builders to understand that we can't fund the manufactured home builder's deposit. And the reason is because that deposit isn't going to add value to our collateral. So it's not like, again, improving our collateral or building a house on a foundation as you go. We're going to be able to fund 100% of whatever it costs for the manufacturer to build that house and deliver it. But we can't fund it until that house has been delivered, set on the foundation, and now, part of our collateral. So it's important to know that, because some manufacturers charge small deposits, large deposits, and it's money that you will be reimbursed for by us once the house is delivered, but you're gonna have to know what that amount is, because you're gonna have to pay that up front and then obviously get reimbursed for it once the house is delivered. So that's an important thing. Deposits can be significant, and that may limit you as a builder as to how many you can do. Pro tip when it comes to manufactured housing with ABL is that we have a 0-point program. And I talk about speed of money. That's the business I'm in. But here we have the ability to do a low rate with a point or 2 points, or the ability for borrowers to choose a higher rate with no points. And when you combine our 0-point program with how manufactured homes are funded and the timeline and how we talked about interest being calculated on balance, and the period of time you as a builder will have your loan fully funded, and how it's not very long when you actually calculate the interest out. This 0-point program is amazing, because you're not paying any points at close. Your interest is going to be limited to, delivery and sale in that time frame. So you have the ability to lower borrowing costs significantly. And I have borrowers that I've funded 25 of these, I think now, and they just keep coming back doing 4 builds at a time, because that seems to be the right math for them. I've funded 8 at a time before. We have the ability to blanket these into multiple builds under one loan. Couple that with our 0-point program and allow you as the builder to just build and to pay almost like bank-like cost of capital, because you're not paying points at close. You're paying very little interest during the initial period. The house gets delivered, and then your interest carry might be 90 days at a higher rate, but even if it's sub 12%, that's 3 points of interest that you're paying in total on your loan, which is really compelling. So the next question might be does the rate change, or does the leverage change because it's manufactured or modular? And the answer is no. It's all the same. We're lending up to 90% of total project costs on these manufactured builds. So like I've said, it's 70% of the land, plus 100% of construction, plus interest carry, even as long as the loan to value doesn't exceed 75%. So we size these loans, price these loans exactly the same as our others. It's all experience driven, and our rates are in the single digits, and we're funding a lot of these. It's exciting. If you're a builder looking to get into manufactured or modular housing and have any questions relating to how these deals get funded, don't be shy. Reach out, leave a comment. I'd love to fund your next deal.